This is Bob Payne, Chief Investment Strategist, here at Payne Capital Management with this week's market update. This week on the Street of Dreams, stocks tumbled after a robust jobs report dampened Wall Street's hopes for further interest rate cuts from the Federal Reserve this year, pushing major benchmarks into negative territory for 2025. U.S. payrolls increased by 256,000 in December, surpassing the 155,000 expected by economists. The unemployment rate, projected to remain at 4.2%, fell to 4.1% for the month. The yield on the 10-year Treasury note rose to its highest level since late 2023 following the report. Now, that's good news for the economy, but not for the markets, at least for now. Traders now give 97% odds that the Fed will maintain current rates at its meeting later in January, and they believe the central bank will hold rates steady in the March meeting as well. Stocks faced more bad news on Friday after the University of Michigan's Consumer Sentiment Index indicated concerns about inflation. But the important thing that gets lost on weeks like this is the message of why rates are moving higher. It's because the economy is doing better than expected, which means the potential for better earnings, less risk of a recession, and that's going to dictate long-term returns versus a recent sell-off in this week's market. But imagine for a moment that good economic news is just that, good news. If more Americans have jobs, they'll be able to spend more money. About 70% of the U.S. economy is dependent on consumer spending, after all. And while inflation has remained stubbornly above the Fed's long-term goals, there are few signs that it's about to start raging again. In general, the market tends to rise when the economy is expanding because corporate profits are expected to be strong, allowing dividends to be increased. When interest rates rise, all markets adjust down in price to fit the new reality. In other words, investments went on sale this week. As I look forward, the recent fizzle in the markets will turn to sizzle as investors turn their focus back towards economic fundamentals. And last I checked, it's buy low and sell high, not the other way around. Just don't let a temporary short-term pullback in the market get in the way of your long-term investment success.